Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Investors locked into tariff headlines as talks between the EU and US intensify. There's still an hour to go until the closing bell, and right now all indices pointing higher, with both the S&P 500 and the Nasdaq sailing to fresh all-time highs during intraday trading. Let's welcome in now. We've got Kevin Mon, Chief Investment Officer at Hennigan & Walsh, our Washington correspondent, Ben Werschkul, and markets reporter Josh Schaefer, who are here to break down all the action. Ben, we're going to start with you, my friend. It does appear like President Trump, Ben, still playing kind of hardball when it comes to that self-imposed August 1st deadline. Ben, walk us through the latest.
Yeah, so the theme of the day, I think, on the trade, and there's all these different trade fronts, but I think a theme of the day to watch is a bunch of different countries and blocs kind of essentially publicly setting plans for what the world looks like if there's no deal by this August 1st deadline that we're all focused on. And this comes, as you mentioned, with President Trump and his team setting sort of hard conditions for a deal. Europe is the central one, as you mentioned. What we got from them is a series of reports from Brussels in recent hours, basically about what Europe would do if they don't have a deal by August 1st. That could include retaliatory tariffs. It could also include what are called anti-coercion instruments, which would be a major escalation and would essentially allow the EU to restrict U.S. trade. We're seeing it on other fronts as well. Brazil and India are two, where what we've seen is leaders in those countries talking to their local media, essentially to lay the groundwork of how there might not be a deal on this August 1st deadline. India was here in Washington this past weekend. They came away talking about a mini deal, but with an announcement date there in September, October. So not August 1st. Same with Brazil, who were facing 50% tariffs, and they saw some of their leaders giving interviews there saying this may not be done by then, and we may have to sort of deal with this 50% tariff, at least for the short term. You're hearing a lot of this from the White House side too, as well. Treasury Secretary Scott Bessent was on CNBC today talking about how they're in no rush and they're looking for quality deals. So I feel like I'm on every time talking about how it's kind of hard to know with these deadlines, but we're sort of seeing what this August 1st deadline is going to actually be and what it may not be as a lot of these continue on.
And Ben, switching gears a moment, but staying with all things Trump here, White House watching the dollar drop, Ben, and maybe debating whether that's a good thing. I know you've been following that story as well. Ben, what could it mean for Trump's agenda?
For sure. So a notable feature of Trump's first 6 months, which just ended yesterday, is that the U.S. dollar has dropped almost 10% over that span from early January. And what that comes is Trump often reiterates that he wants a stronger dollar. He talked about it just last week. He said he would never, ever let the dollar slide. But there is a kind of recognition among some corners of Trump's cabinet, this is reflective of a debate there, that there are at least some benefits to a declining dollar, especially on this trade front. Commerce Secretary Howard Lutnick was pressed this weekend on CBS about rising consumer prices and talked about how the declining dollar could soften that some. The overall message here from the White House, which a White House official reiterated to me just recently, is that the administration's position is a stronger dollar, a bigger dollar, but there are key factions in Trump's economic team that are open to a weaker dollar to solve a lot of these issues and kind of soften some of the impacts. So how that plays out in the coming months remains to be seen, but the dollar is down significantly over these 6 months.
Kevin, we'd love to bring you in here as well, get your take on what you're seeing out of D.C. What do you make of it?
I believe at some point we need to see an actual announcement of an actual trade agreement. We keep getting these teases that these trade agreements are coming. And I think the market has largely shrugged off the threat of these trade agreements right now, believing that the tariffs are going to be much less severe than what we originally anticipated. So we need to see an announcement, particularly as it relates to the European Union, one of our largest trading partners.
Can I get your take, Kevin, quickly on what Ben was talking about there, which is a subject we talk about a lot, the softer dollar. Yeah. How do you see that rippling through earnings season? That should be, Kevin, a tailwind for the multinationals.
It should certainly be a tailwind for the multinationals going forward. I think if we do see a weaker dollar, if the Fed does cut 2 times this year, as they're suggesting that they still will, that should be yet another factor that's going to weaken the U.S. dollar and be a tailwind for the multinationals. But I don't think the multinationals is the only way to play that. In fact, I still think there's some steam behind that international stock outperformance, which we can touch upon later.
We sure will. Meanwhile, let's bring in Josh Schaefer, of course. What is happening, Josh, Josh, with earnings anticipation in markets right now?
Yeah, Josh, so we had a couple large companies report today that we were focusing on. So you see Verizon here, that stock rising off of its earnings report. I'm looking at our trending ticker section of the Yahoo Finance website. You can also see Cleveland-Cliffs is on there. That stock is up over 12%. But a trend, Josh, that I was talking about earlier, sort of off air, that I've been watching is just simply stock reaction. So you're seeing Cleveland-Cliffs and Verizon are both up after their earnings releases, but when I flip to the year to date, it's been a little bit of a different story for these stocks, right? So you see Cleveland-Cliffs here was actually down on the year entering this report. Essentially, Verizon also hadn't done that well. Now I want to flip to two stocks that reported last week that have been very hot this year and really hot over the last 2 years. So you take a look at Netflix. The 5-day on Netflix, that stock fell 5%, remember, last week after beating Wall Street's estimates on both sales and earnings, and then lifting its full year sales guidance. You flip over to, I'm going to take a quick look at JP Morgan, which has also been a very good stock in the financial sector over the past year. That 5-day chart, or we'll even go for a 10-day to get JPM's full earnings reaction in there. Yes, you've seen a little bit of a rally, but not a massive reaction. That stock had been up over 40% over the past year. So Kevin, I guess what I'm curious with here, when you look at just the different reactions we got and maybe the lack of a bid that a big tech stock like Netflix gets, I mean, is there any sort of read into where we're at with the market at record highs and if tech can kind of keep leading this market, or is the expectation at this point maybe too high for some of the big tech companies?
Yeah, I might suggest that, in my view, it's been a good but not a great earnings season thus far. According to FactSet, year-over-year earnings growth for the S&P 500 index is around 5.6%. Good, but if that holds, that would mark the fifth slowest quarter, going all the way back to the fourth quarter of 2023. So yes, we're seeing earnings growth, but not as high as we saw previously. We do need tech to come to the plate and actually deliver some even stronger earnings results. We know how much of an impact tech has on the large stock indexes and also on household portfolios, since the technology sector is the most hold sector across retail investors. So hopefully tech continues to come through. Everyone's going to be waiting to see what NVIDIA reports down the road. But for now, we have to dissect everything we're getting out of the tech sector. And I liked what I heard from Taiwan Semiconductor last week when they raised their full year forecast by 30%.
All right, we're going to get more into that name, by the way, later in the show. Josh and Ben, meanwhile, thank you guys. Appreciate it. Joining us now is Mohit Mittal. He's Chief Investment Officer, Core Strategies at PIMCO. That firm has more than $2 trillion in assets under management. Mohit, it is great to see you on the show. Maybe start, Mohit, with what we were just talking about there. Trade tensions, tariffs, Mohit. We have August 1st. That is circled on our calendars. As investors, we're all waiting for it. I'm curious, Mohit, just to think about, how are you thinking through that deadline? As a CIO, what are you telling clients?
Yeah, thanks for having me, Josh. So I think the way we are thinking about it is, even if we take a step back from that one immediate deadline, what we are observing is a broad, somewhat slowdown in the data. Add to it the incredible amount of uncertainty that is being created by these broad tariff policies, and those uncertainties are not going to go away on August 1st. Meaning that there might be some extensions, there might be some deals, but those uncertainties are here to stay. And what that means is that that uncertainty feeds into corporate sentiment, that uncertainty feeds into consumer sentiment, which means that as we go forward towards the end of the year or next year, growth continues to slow down towards, say, 1%. And then add to it the context around earnings expectations. So when you look at the earnings expectations for this year, they are in the high single digits, same for next year. So the balance of risk in our mind, given kind of these uncertainties, and in the context of expectations, which are quite optimistic, the balance of risk seems to be towards kind of under-delivering relative to expectations.
So is your point, Mohit, I'm just looking at the popular averages here, we are agreeing across the board again, Mohit. Is your point that you think investors are being a bit complacent here?
Absolutely. I think that's kind of the view here, that investors are being complacent in, say, for example, kind of the equity markets, even in lower quality segments of the credit markets, where valuations are near historic tights. And when we contrast that to higher quality fixed income, where investors can get, call it 6-ish% yield in a very, very high quality manner, that looks like a very attractive alternative in this kind of environment of elevated uncertainty and ongoing complacency.
Kevin, bring you in here as well. Mohit's point is well taken. To the extent, Kevin, I wonder whether you get nervous when Nobody else seems to be nervous.
Absolutely. And I think what we need to understand is that we're pretty far along this bull market run. Through the first 73 trading days of 2025, the S&P 500 was down 10.2%, the fifth worst start in history. Now we've seen a significant move higher since day 74. How much longer can that run last? So I would anticipate some more short-term bouts of volatility ahead, whether it's due to the lack of trade agreements being announced, perhaps tariffs being more severe than when we originally anticipated, or the Fed staying on pause for even longer than many are currently forecasting right now. That could all create more volatility, but I think each part of that volatility brings more investors back into the market.
Mohit, what do you say to those folks who come on the show and they're bulled up, they're more constructive? And honestly, Mohit, I think they basically tell me, listen, Josh, just don't overthink this. The reason the market's higher is because the fundamentals look good, solid earnings, solid economic data, and a Fed that seems to want to cut later in the year. What is your response to that?
Yeah, I think there's a lot of merit to that, and that certainly can hold, that we can continue to see equity markets do well, we continue to see credit markets do well. But I think what is also interesting is that in the last, call it 15, 17 years post the GFC, generally buying the dip has always worked out. And I think many factors have been behind it, but one of the factors continues to be around kind of ongoing large fiscal deficits, as well as a strong monetary policy support through quantitative easings. Whenever there has been a big stress, you have seen both the fiscal authorities as well as monetary authorities come to the rescue. I think where we are, as we think about kind of where we are, we recognize that because of high debt to GDP for the US federal government, you have some constraints at the fiscal level in order to be able to address the next crisis with larger fiscal deficits. Same thing, with the central bank. I think the QE would be somewhat less easier to do next time around, given the prior inflation or concerns around inflation that the prior QEs may have created. So in that context, we recognize that I think certainly you could have an environment where earnings continue to deliver and equities do well, but the balance of risk seems to have shifted to the downside. And I think the last point I would highlight also is that a lot of optimism is being built around the idea that we will realize the productivity enhancements because of all the investments in AI-related chips, energy, all of that. In a scenario we don't realize those productivity enhancements, I think certainly the balance of risk again shifts a little bit to the downside.
You mentioned those monetary authorities, Mohit. When it comes to the Fed, where is the Fed in your story? How many cuts do you expect this year? Does the economy require a cut?
I think, in our view, as I was mentioning, kind of some slowdown is happening in the data. I think 1-ish% growth for this year. And in that environment, central bank likely can deliver up to 2 cuts this year. Certainly, they are in no rush to cut, but starting September, maybe a couple of cuts for this year, and then maybe another 2 to 4 cuts next year. But should there be a little more slowdown, there is plenty of room to cut much more than currently priced in, with Fed funds rate at 4.5%.
Let me get your thoughts on the benchmark 10-year, Mohit. It's back to 4.37 here. Where does it head from here, near intermediate term?
So we have shifted in our portfolio somewhat overweight bias towards interest rate risk, meaning that we think over the medium term, the balance of risk is towards lower rates than higher rates. That does not mean that 10-year cannot go somewhat higher than here, but if we take a little bit of a longer horizon, 1 to 3 year horizon, we think over the next 1 to 3 years, 10-year likely heads lower from here, given the growth and the inflation backdrop.
Mohit, great to have you on the show today. Thanks so much for your time.
Thank you for having me.
We are just getting started here on Market Domination. Coming up, Trump Media, that stock surging after acquiring $2 billion worth of Bitcoin. We'll discuss the impact of the move in the 4 p.m. hour. Plus Tesla earnings, they're on tap this week. We're going to hear from an expert to preview what to watch from Elon Musk and the EV makers. Stick around, much more Market Domination still to come. Now time for some of today's trending tickers. We are watching Verizon, Domino's, and Dollar Tree. We're going to start here with Verizon, which is seeing its shares skyrocket after topping earnings expectations for the second quarter and raising its outlook on the low end of its full-year earnings guidance. So this one, since you're in print, Kevin, so post-second quarter revenue, that looks like it beat, did raise the profit outlook. The performance, and I thought this was interesting too, Verizon did call out what they call the favorable tax reform. That was in part what seems like it led them to raise some full-year guidance metrics. CEO saying Verizon has momentum and clear path forward. What do you make of it?
All good news for investors of the stock, for certainly. I would love to hear a dividend increase, but maybe that's coming down the road. But it's a very competitive field being in that communication services sector right now. And Verizon continues to put out new programs to try and lure new investors, both on the retail side and on the business side. And everything they're doing right now seems to be working.
All right, let's stick with the consumer, because here's another one. Domino's reporting its second quarter results, sharing massive same-store sales growth while stagnating on revenues. Shares lower today. So this one, U.S. same-store sales rising. It looks like more than estimated. Did maintain the full-year comparable sales guidance. They did, it looks like, Kevin, talk a bit about the economy, the global economy there as a reason. Apparently, here's one, the launch of its Parmesan stuffed crust pizza. I haven't tried it, but that, they said, attracted new customers. What do you make of the results?
I mean, they beat on U.S. sales for the first time in 5 quarters. That's attractive. I haven't had a Domino's pizza since the junior year of college. I don't know if the recipe
You live in New Jersey, where there's just too many good options.
Pizza. You don't put Parmesan in the crust. Just leave it as is, thin and crusty. But apparently someone is buying them.
Yes, right. What do you make, I mean, here's a general take. You think Domino's, kind of broader view in the consumer, what do you make so far of what you're hearing from the consumer?
Yeah, I think what we're learning from both Domino's and Dollar Tree is right now consumers are being a little bit more frugal. I think that's going to trickle through into the consumer staples sector as well. According to the Federal Reserve, the economy should slow to 1.4% this year. That benefits some of the smaller, more value-oriented brands like a Domino's, like a Dollar Tree.
Well, let's talk. Let me get your take on Dollar Tree. That was one I wanted your comment as well. There was some kind of bullish commentary on the street. Let me ping that off you. Barclays, for example, calls it a cleaner growth story now following what they're talking about, that Family Dollar sale. Some momentum they talk about observing Q1, accelerating Q2, set up well for fiscal 25 and 26. Looks like they take their target is 120 over there. JP Morgan also, they raised the target, Kevin, to 138 on this work. 38. Fieldwork suggesting they told clients potential incremental upside driven by strength of the base business. The average target is around 100 here. Stock has enjoyed a nice run already.
Yeah, I mean, retail sales was up 0.6%, well beating estimates of 0.2%. But I think that's trickling through to these more value-oriented brands like a Dollar Tree right now. Consumer spending is so important, Josh, as we know, because it counts for 70% of economic growth. But look at where the spending is taking place. It's going to areas like Dollar Tree, like Domino's right now. And I think that's telling us something about where the economy may be going, at least in the eyes of the consumer right now.
Meanwhile, here's another name I'm going to want your take on, Kevin. Shares the drug manufacturer Sarepta. They're plunging. That's following 4 downgrades and a battle with the FDA now over the company's refusal to take a gene therapy drug off the market. With more on what this means, we have Yahoo Finance senior health reporter Anjali Kamlani. Anj.
That's right, Josh. As you mentioned, several downgrades for the company, and it is extending declines that started on Friday. That company was down about 35 to 40% on Friday alone. Over the weekend, it seems like it's been able to convince some investors and some analysts that it is making the right move, but we will have to see how this basically all plays out in its standoff with the FDA. Sarepta basically not disclosing a patient death in a clinical trial that it is actually ending as part of restructuring that the company announced after Q2 earnings last week. Once the report of the patient death came out, lots of questions about why it was not disclosed came up, as well as faith in management sort of shaken. Analysts talking about the idea that the company has not been forthcoming with the information, as well as trying to play it off. Then there's the FDA asking the company to take its current drug on the market, that's Elvidis, an unrelated drug, but similar in its technology, essentially the delivery mechanism, as the one that was in clinical trials. And so there had already been 2 patient deaths earlier this year from that drug, Elvidis, and that is the reason why the FDA asked for, or requested rather, the company to halt shipments. Sarepta has refused to do so, saying that there is no clinical reason for doing so. And so that standoff is where things are. Analysts are waiting to see how Sarepta handles this and what this could mean for the future of Elvidis. That drug alone in Q2 brought in more than half of revenues for the company. So it's a very big pot of revenue we're talking about and could impact Q3 and beyond, including for the next year, what those projections look like. So things are really shaky for this company right now.
Angela, let me ask you, is this just a Sarepta story? Is it just a narrow Sarepta issue, or is it potentially a broader gene therapy treatment issue?
This specific level of back and forth with the FDA and sort of concern is a Sarepta issue. They have been one that has been sort of watched very closely because of how they've handled these issues in the past. But gene therapy broadly has been suffering. There have been a lot of setbacks in that area, and so you have seen companies fall out over the recent past.
Kevin, your thoughts on this one?
I mean, gene editing, gene splicing is really the future of healthcare innovation right now. And I think the Sarepta story should serve as a reminder to investors to not just try and pick one or two biotech stocks, but rather build a diversified portfolio of small cap biotech stocks that are in different areas that large cap pharmaceutical companies may be interested in acquiring. Sarepta, obviously, is having some difficulties right now, to say the least. But that doesn't mean there aren't other companies that could step in and now look more attractive to large cap pharmaceuticals who want to add a gene editing type of company to their pipeline of products. So I think this just, once again, Josh, serves as a reminder to investors to build a portfolio of biotech stocks, not just try and pick a one-hit wonder, be diversified and not concentrate your holdings.
Does that mean, Kevin, I want to pick a ETF? Is that the vehicle I should be looking at?
I think an ETF, a mutual fund. At Smart Trust, we have our own portfolio where we look for those companies that have at least one drug in FDA level 2 or level 3 approval status, that have a drug trial coming up in the next year, and that are in areas that we believe large cap pharma would be attracted in.
All right, Anj, thank you. Appreciate it. Coming up, Tesla earnings, they're on tap this week. We're going to hear from an expert on the other side to preview what to watch from Elon Musk and the EV makers. Stick around, much more market domination. That's what we're doing. Well, Tesla reporting second quarter earnings after the markets close on Wednesday. In one area investors will be, of course, keeping a close eye on. That would be the company's outlook as President Trump's big, beautiful bill phases out energy tax credits. For more, we're bringing in Jed Dorsheimer, Group Head of the Energy and Sustainability Research Sector at William Blair. Jed, it is good to see you, my friend. I think, Jed, correct me if I'm wrong, this is the first time I think I've spoken to you, Jed, since you did downgrade Tesla. You went to the equivalent of a hold, Jed. I think you did that a couple of weeks ago, earlier this month. Maybe start there, Jed. Walk us through why that downgrade.
Yeah, Josh, thank you for having me back. And it is the first time I think we've spoken since the downgrade. I don't think the big, beautiful bill is going to be beautiful for Tesla. That's kind of the heart of it. I mean, I've had, a positive bias on Tesla for a long time over my career, which has benefited, which has worked out quite well. But I think there's some challenges, and I don't think those will manifest this quarter or even next quarter. In fact, if anything, I think you could actually get some upside this quarter and next quarter as you pull in deliveries before the expiration of the tax credit. But there are challenges, and I think the challenges are going to show up primarily in the auto side of the business, but also a little bit in energy side, two different things going on there, and in the profitability. And that's why we downgraded the stock. We would prefer a lower entry point.
And when I talked to you, Jed, correct me if I'm misremembering, but your thesis, I mean, your reason that you were constructive on this name, it was the energy story, correct, Jed?
Energy, and then also, I think a lot of people are looking at robotaxi and the future, the potential. Right now, I would say that, Tesla has been a stock that has transitioned, the valuation has moved from a lot of their core business to the things that they're going to do. But energy was our primary focus.
In the core business, Jed, I just spoke to another analyst, smart guy like yourself. Mm-hmm. He is more constructive on the name. And I talked to him about that core EV business. And in broad strokes, he was more optimistic. And I asked him why. And he said, well, it's that Model Y revamp. It's that new affordable model on the way. Your reaction to that argument?
I think those are all fair. The longer wheelbase in China on the Model Y, those could provide areas of relief. But across the board, all of the models are going to get $7,500 more expensive. And you have $2.8 billion of tax credits, which are pure margin. Those are the structural challenges that investors are going to have to wrestle with. And neither of those are going to show up this quarter or the next quarter. So quite frankly, I think if you're a trader and you're looking at the very near term, you could actually get, a little bit of upside here. But my job as a fundamental analyst to try and look at what's happening over the next 1 to 2 years or sometimes even longer, these are going to be challenges to the business until robotaxi or humanoid robots, until those business units become a larger, more material part of the of Tesla's P&L.
If we're aware of these challenges, though, Jed, Musk is aware of them. So what are the levers he's going to pull to navigate these dynamics?
I mean, I think you're seeing some of that in terms of change of personnel. And, I would suspect that, they're not going to allow the vehicles. So I think they're going to push really hard. And I think Elon's getting back into, the position he probably feels most comfortable in. He is a great operator and leader, and I think he's going to push hard now that his focus is squarely on Tesla.
Musk is now saying, listen, he's back, he's committed. There were, of course, investors who were getting kind of nervous there, Jed, I think, when he was talking so much about forming this new political party, questions understandably about his focus, his attention. Were you getting questions about that from your clients?
We got a couple, but I would agree with his statements. I do think that Elon is back and focused on the business. If we did not have the structural challenges to the subsidies and the zero tax credits expiring, I would be taking a more constructive stance on this discussion with you. So. I'm hopeful that he's going to be able to mitigate some of these things, and that we'll be able to become more constructive on the name.
When you are thinking about that robotaxi service, Jed, how quickly do you think Musk can reasonably expand that service?
I think that's going to, we don't have it materially impacting our model until 28. So I think it'll be a challenge to pull it in much faster than that. And
what Jed, would you say are his competitive advantages as he takes on Waymo there?
Well, the competitive advantage is that he's, like most things that Elon does, is that they're taking a vertical integrated approach where Waymo is partnering with Uber. There's pros and cons of that. If Tesla can get this to work and they have a fundamentally lower cost structure compared to Waymo because they're using vision, so their tech stack is going to be cheaper, then they can weaponize price and take market share. And that could result in faster growth or a more profitable business model compared to the Waymo-Uber partnership.
Question, Jed, final question for you. So you go down the equivalent of a hold. I'm sure you got questions from your clients, Jed, about, listen, what are the, Jed, upside risks I need to think about to this decision? What'd you tell them?
Upside in terms of, what's going to cause it? Well, I think the upside here would be, we already have the delivery numbers, so we need to look at what the profitability is. Some of the things we're talking about are further out, so you probably get a little upside on the margin profile. And then next quarter, you're not going to get hit with, you're not going to get hit with a gap in deliveries. And you also have that refresh and longer wheelbase. So those are some of the upside opportunities. Now, the downside opportunities would be that you could create a bit of a vacuum as you pull forward demand, knowing ahead of time that these cuts are going to occur. So you could actually get a larger delivery number for next quarter that leaves you with a weaker Q4. That's probably the downside risk. So it really is a little bit balanced here.
Jed, always great to see you and to have you on the show. Thank you, sir.
Yeah, thanks for having me back.
Kevin, your thoughts on all things Tesla?
Yeah, I think prior to the last year, I viewed Elon Musk as being the P.T. Barnum of electric vehicles. And then all of a sudden, he ventured into the political stratosphere, if you will, and brought Tesla along with it. But now he's back at Tesla again. And I just wonder if investors are viewing the Tesla investment opportunities under the wrong lens, viewing it as a pure electric vehicle company that's going to be impacted by these tax credits. I'd make the argument, Josh, that 2-3 years out, we're going to be looking at Tesla as a robotics company, much less of an EV company, and there's going to be even more opportunities for growth as a result of the play that they have in robotics.
Well, you bring up a good point, which is that the interesting thing about Tesla and earnings is that there is some not insignificant number of Tesla investors, Tesla shareholders, and they're in it, I think, Kevin, because they're believers in Musk.
Absolutely.
And they're believers in his vision.
Yes.
And to some extent, I think they almost look through the numbers because they think, hey, Musk is right. The future is autonomy, it's robots, that's the future, and Tesla's going to have a big share of that.
And that is what the future is going to be, autonomy, robotics. We're seeing that through the AI revolution. Tesla now is becoming not a backdoor play into the AI revolution, but investors have to be patient. It's going to take some time for Tesla to get there. They haven't even fully gotten there and become fully profitable on the EV side just yet, and now there's more challenges for Tesla on the EV side. But if you start looking at them through the lens of robotics and everything that Elon's going to now do to make them innovative in that field, I think they're going to be pretty excited.
That is the bull case. All right, thank you, Kevin. Appreciate it. Coming up, Google and Intel among the major players reporting earnings this week. Going to preview the numbers and get you set for everything you need to watch for from the results. Stick around. Much more market domination still to come. Big tech earnings on deck with Alphabet reporting second quarter earnings on Wednesday and Intel on Thursday. For more, we are bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, we're looking at obviously Alphabet, Google's parent company, coming in first. As you said on Wednesday, there's really a lot of conversation as to, if they're going to keep up that AI spending and what they're seeing as far as Google Cloud adoption. But let's just go over some of the numbers real quick. For the quarter, we're expecting to see adjusted earnings per share of $2.17. That's on revenue ex-TAC, which is traffic acquisition cost, the amount they pay companies like Apple, et cetera, to get traffic acquisition, of $79.6 billion. That's an 11.6% jump versus the same period last year. And what we're looking at as far as advertising revenue is expected to be $69.6 billion, up 7.7%. But really, it's the Google Cloud platform that I think everyone's mostly interested as far as potential growth. And there, we're expecting to see 26% increase year over year to 13.1%. The cloud operating income should come in at 2.2%. That's a 91% year-over-year increase, but it's not as high as we've seen in prior periods. So really interesting there. Obviously, the big to-do with Google continues to be the Gemini rollout that it's doing across its various products, whether that's on the consumer side or the enterprise side, with workspaces and cloud being kind of their future growth engine or current growth engine, whether or not it's able to catch up to the likes of Microsoft and Amazon. But one of the things worth keeping in mind is, well, if they do have a good quarter, that's all good, great, and grand. But next month, we're expected to hear the results of the remedies trial that the company was going through with the DOJ and the department's antitrust case against them. And part of that could mean forcing Google to sell off its Chrome browser. Another could be forcing it to abandon agreements like it has with Apple or Samsung that see those companies use Google Search as their primary search engine. So, a lot coming down the pike for Google in just the next few weeks. And then outside of Google, the following day on Thursday, we have Intel. This is kind of bigger than the results kind of question. We're expecting potentially to hear anything from new CEO Lipton on what they're doing with regards to the kind of turnaround effort there. There have been reports that perhaps Intel will abandon 18A as far as offering that technology as a chip fabrication technology for third-party customers. They would still use it internally, but they would focus more on their upcoming 14A. That's their next generation after 18A chip technology to better compete with TSMC. The Oregonian has done a lot of good reporting on some of the layoffs there. They've reported that they're shutting down their automotive business, that they're seeing layoffs or moving to outsourcing bracing for their marketing department and doing some layoffs at its factory. So, a lot of cost-cutting measures here, as well as potential moves for that technology that they have for the fabrication technology. For the quarter, look, I mean, we're expecting to see earnings per share of 1 cent. That's adjusted EPS of 1 cent on revenue of 11.8 billion. That would be down from 2 cents in the same quarter last year, and revenue of 12.8 billion. One of the things to look out for is the potential pull forward of CPUs as far as desktops and laptops and data centers go with regards to tariffs, because there was questions of will they impact sales of chips or devices. So we may have seen some pull forward, and that could benefit the product side of things. But again, it seems as though the bigger question is, what does this turnaround look like under TAN, and will they continue to use 18A as a third-party product, or will they just keep it internal?
Kevin, your big thoughts on big tech earnings?
Yeah, I would suggest that so far this year, the Magnificent Seven has become the somewhat still Magnificent Three. Those three, of course, being NVIDIA, Microsoft, and Meta. Of those three, I'm really anxious to hear what NVIDIA reports. We have to wait a little bit on that front, but last quarter we saw that 88% of their revenues were attributed to data centers, while just 12% to GPUs. That's important because they're diversifying out their revenue stream, and it's also a reminder that they sit at the hub of the overall AI ecosystem. So the AI revolution is alive and well. It's a long road, and people need to be patient with the technology sector when you invest in that type of sector that has that much volatility.
All right, speaking of all things tech, we're also taking a look at the chip sector. The AI trade remains intact, but heading into earnings, inventory, and tariffs, we know they're top of mind for investors. For more, I want to welcome in here John Vinn, equity research analyst at KeyBanc Capital Markets. John, great to see you as always. Maybe start there, John, just sort of higher level. You think of that mega AI trade and trend, John, and certainly the names chip investors want to play that. So the NVIDIAs, the Broadcoms, there was some questions about that, John, not too long ago, but now you look at it and it certainly looks resilient, or at least that's how investors are betting on it. But what do you see, John?
Yeah, I would agree with that. I think the AI chip sector remains broadly very resilient. I think there's very strong, robust demand across the board. And then with the recent news that the U.S. administration now has lifted the AI chip ban on chips to China, companies like NVIDIA and AMD are once again going to be able to start shipping into the China market, which is obviously a very significant market for the AI sector.
And so, John, do I stick with NVIDIA and Broadcom here? Do they remain overweight? Do they remain buys? No AI CapEx peak in sight?
Yeah, I would say those are probably the two best positioned companies within the AI chip sector, right? NVIDIA, obviously, we think they have a significant commanding lead in the space. The shift to their Blackwell rack scale GB200 system is a game changer. It really places a lot of distance between them and the competition. And then Broadcom, we also think is really well positioned in the AI chip space. I think thematically, how we think about it is Broadcom is kind of the leader in the custom AI silicon space, right? Their largest customer, Google TPU, by far has one of the most successful custom AI chip solution in the sector. And then they're starting to ramp in the second half here, Meta with their MTIA AI chip, which also should be an incremental tailwind.
What about, John, export controls and tariffs? Those are sort of moving targets here. How should we be thinking through those dynamics as investors?
I think what you're going to see in the near to medium term, right, because these policies change and are quite dynamic, that I think investors are going to want to understand what the incremental benefit and tailwind related to China shipments are. And I think in the near and medium term, until we get better visibility in terms of what the long-term policy and geopolitical situation with the U.S. and China is, I don't think that people are going to bank on those China revenues longer term, right? But I think in the near term, you're going to hear NVIDIA talk about what its total AI revenues are. I think you're also going to get questions, and you're going to get them to ultimately back out what the China contribution is. And I think people are going to keep tabs of that until we get better certainty in terms of the relationships between U.S. and China.
I also, John, I want your thoughts on Intel, earnings on deck. I know you got the equivalent, John, of a hold on that one. How come?
I think they've just got too many challenges, right? And obviously Lippo coming in is a big change. We think is for the positive, but it's going to take a long time. They've got a lot of things ahead of themselves, right? 18A and Foundry is going to be a very long path ahead for them, right? It's going to be several years before they get meaningful revenues. And on the core IDM business, they're under attack on multiple fronts, right? They're losing share to AMD on servers. They're losing share on client PCs to ARM. And they don't have a credible AI strategy at this point. So obviously they're huge laggards to the rest of the AI chip sector.
You mentioned AMD there, John, which has had a nice run, about 30% this year, but I know you've got the equivalent of a hold on that one as well.
Yeah, we are sector weight on AMD, just on concerns about their ability to sustain and compete against NVIDIA longer term. But I would say the near-term setup for AMD looks really good. They are ramping their new GPU, the MI355. We think demand is looking extremely robust. We think they're probably on track to do $7 billion in AI revenues this year. Server CPU, they just launched their latest generation chip Turin. It's gaining share at Google Cloud. It's ramping quite nicely. And then on the PC space, they're holding their own against Intel there. And I think the near-term setup for AMD looks very, very robust to us.
John, always appreciate your time in those picks. Thank you.
Great. Thank you, Josh.
Dan, Kevin, want to bring you guys back here as well. Kevin, you were listening there. We were talking about that mega sort of AI trade and trend.
Yes.
It looks intact right now, but what are your thoughts?
I think people need to recognize that the AI revolution is a long road and it's filled with many potholes. Ultimately, there's going to be many different winners. I think Microsoft may be the ultimate winner, but they're not going to be the only winner. And there's likely to be even more losers. So you have to look at the whole ecosystem for opportunities. The software plays, the hardware plays, the chip plays, the data center plays, the power solutions plays. And I think that's how investors can better navigate the AI revolution going forward, not just concentrating in any one name or one particular component, such as chips, within the ecosystem.
And Dan, it wasn't so long ago. I know there were worries. We were talking about the NVIDIAs, and there were some concerns. It was DeepSeek. There were concerns about maybe 2025 was representing some high watermark, Dan, in terms of AI CapEx spend. But right now, it seems like investors are willing to bet that that's not true and that the trend remains intact.
Yeah, I mean, look, Google said in their prior earnings release that they were still on track to spend $75 billion this year for building out their CapEx. They also said that they were still capacity constrained in the prior quarter, in the current quarter. So look, they're going to continue to build out. Microsoft's going to continue to build out. The entire issue with DeepSeek was about training. And so then the kind of thesis became, okay, well, these models benefit from high-powered chips like NVIDIA's when it comes to inferencing or actually using them. And so that's been beneficial to NVIDIA as well as the broader AI trade. I think the bigger thing is going to be, not necessarily on the chip side, but on the software side. And, when Microsoft and Google and Amazon really start to see revenue ramp up from their AI services. On the chip side, look, yeah, it's basically just NVIDIA, Broadcom benefiting handsomely. Then you have, the hyperscalers that have their own chips, but NVIDIA is still going to be in there. AMD to a smaller degree, and Intel, I mean, basically just kind of, floating around with the CPU side of things. It'll be interesting to see what happens down the line, years and years down the line, when, some of its biggest customers maybe tail off a little bit, or we have to just see what happens because, in its most recent earnings, NVIDIA said that I think it was just slightly less than 50% of its revenue comes from those hyperscalers. And so there's that heavy concentration of revenue coming in from those sources. What happens down the line, we just have to see.
Dan, thank you, sir. Appreciate it. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.